I hope it's been recorded. 1 minute. Yeah, it's being recorded now. So this is chapter 6, new lesson. It's called cost, volume, and profit analysis. So basically that is pretty much what we have learned at advanced level. But I'll try to explain you the logic behind this. Learning outcomes. You must be able to explain the difference between absorption costing and marginal costing after learning this. Because absorption costing was discussed under cost ascertainment. We absorb costs into products. But the marginal costing is a different exercise where the marginal cost, that means the cost by which the total cost changes when the production changes, increases or decreases by 1 unit. So you know the meaning of marginal. Marginal means additional. When you produce additional cost, what would be the cost? That is marginal. Simply speaking, it is variable. We will be discussing in detail. This is learning outcome. Second one, justify the use of linear cost and revenue function. So here, in real life, costs may behave differently. Costs may behave differently. But for the understanding purposes, we use linear function. We assume that costs behave in linear functions. In reality, there would be different non-linear functions. Another outcome is the application of numerical approaches to calculate certain values and interpret them, especially when a business is carried out, no matter whether it is a very small one or a very big business like a conglomerate or international corporation. Their processes, like activities, what we call business engagements, need to know whether these actions are profitable or not. Whether we like it or not, profit is a reality within businesses. Then at what point of operation it's going to generate profits, and the region within which you do not have profit. You know that when you do businesses, all of like immediately, like from the very beginning, you can't earn profits. You need to work more, work hard, and increase your volume. After some times, this volume will give you profits. So therefore, we need to know the turning point. The break even is the turning point, right, at which organizational operations will generate profits for you. Next outcome is the construction of this break-even contribution graphs. The same information is presented in graphs. Why? Graphs are very powerful tools of providing information in a highly abridged way. Information written in maybe 100 pages can be given or explained in a graph. So graph is an advanced mode of depicting information. How best we depict these things, and therefore, if that's the case, why do we have to learn this thing? Why have we identified this thing as a learning outcome? But most of the information can be presented in graphs. Then by looking at the graphs, you guys as managers must be able to take decisions. The last learning objective is to identify and explain the assumption. So we will discuss maybe at the beginning, no matter how that is going to be discussed in the order of discussing may change. CVP analysis is discussed with lots of assumption. What is CVP analysis? Simply speaking, it deals with three variables: cost, volume, profit. Again, CVP analysis means a kind of analysis that deals with cost, volume, profit. That's it. Therefore, it is in a way very simple. But costs, volume, and profit are defined and interpreted and used in this lesson with a different meaning, because cost has its own meaning. You know what it is. But here we deal with only two types of cost. That is either fixed cost or variable cost. We are not going to classify costs in any other forms. Therefore, in a way, it is a bit easy, isn't it? Because costs are not going to be classified in any other different ways. Volume. What is meant by volume? It could be anything. Right? It could be anything. But for CVP analysis, volume would be either units or value. Of what? Units or value, maybe the sales units, production units, or maybe the number of services, or maybe number of activities, number of trips, likewise. So you may find out the nature of that particular operation. No matter how it is, it has to be identified as units. For example, number of trips to cover your costs. Maybe if you take transport passenger services in a day, so how many trips are required to break even, to be all right? Then that is the volume, is the number of trips. Volume would be, that is a unit. Huh? So therefore it can be explained in terms of units or in terms of value. Then that is also clear, very straightforward. Profit. You know what is meant by profit. Total revenue minus total expenses. But here, profit is explained in two means. One term is the contribution. Profit is also a contribution. We know that if an organization does a business or carries out a kind of business operation by investing 100,000 rupees, generated 125,000. So profit is 25,000. So then if I want, I can say that my business contributed a profit of 25,000, because you may see throughout our especially accounting management subjects, most of the terms are general terms, but used with specific meanings. Contribution is also a general term, but here contribution has a different meaning. Meaning is the profit, a kind of profit. We will be discussing these things. And the total profit or the operational profit. So total profit, final profit, operational, whatever. So that is the end profit. So you have to understand that each variable, cost, volume, and profit, there are two things are used: fixed or variable, units or value, profit, either contribution or total profit. Then in a way, it is easy for you to summarize as a structure, not to memorize, but to summarize. Okay. This technique, CVP technique, is basically used for a short-term decision making. That means within an identified time period, short, maybe 1 month, 1 day, 1 year, something like that. Sometimes break-even time period would be a longer depending on the nature of business. For example, ship build, aircraft building, right? Suppose that the Boeing or Airbus, Boeing or Airbus wanted to launch new aircraft, introduce new aircraft. They spend lots of money for research and development and so many things. They want to know the number of aircrafts to be sold in order to be break even. Decision can be taken within a short period of time, but the decision really, in order to break even, your operations would last for maybe a couple of years. You understand it, right? But whatever it is, these, when we talk about CVP analysis, it is discussed within an identified time period, normally what we call relevant range. Relevant range. Adala kalape, relevant range. As I just told you earlier, common application is to find out the break-even analysis and profit planning. To identify the level of operating activity, need to avoid losses, that is to break even or to generate a profit. Then guide other decisions sometimes may link to other operations as well. Key point of CVP analysis is to either decide break-even point or plan profits. Now, even though the learning objectives of the fundamental assumptions, it's better, always advisable to discuss these assumptions before. If you know the assumption, that is easy to understand the concepts. So we know that cost can be divided into different variable, fixed, semi-variable, direct, indirect, likewise. But here we classify them into fixed and variable. So that is one assumption. If there are any other costs, they have to be explained either in the terms of fixed or variable. Total fixed cost remain constant at a given capacity level. Okay, sorry for the disturb. Next assumption, variable cost vary proportionately with the changes in volume. Variable cost varies, changes in proportionate to the volume or the changes in volume. What we call propensity to change in volume. You may have heard about this thing in economics. Variable cost changes in propensity to changes in volume. In other words, when the volume changes, units of variable cost goes up, increases in a positive relationship. That's why CVP analysis deals with a simple equation. Actually, from learning perspective, behind this CVP analysis is only basic mathematics equations. That's it. If you're good at simple equation, how do you deal with these things? Variables come independent, dependent, and intercept and the gradient. So those are the concepts that you need to learn. Finish. Selling price, variable cost per unit, total fixed costs are all known and constant. Like that means whenever we work it out, whenever we plan for profit, decide the break-even point, we need to know variable cost, total fixed cost, whatever, all those things are known. They are there. But in the examination, some cost may not be given. It does not mean that we do not know. Don't get it wrong, right? For example, in an examination, you may be asked to calculate the total fixed cost by giving other information. It does not mean that we don't know the fixed cost. Fixed cost is known, but we have not given it to you. You have to work it out. That is the meaning. Because when we deal with variables, always we can use a degree of freedom equivalent to n-1. That is why some questions are set in such a manner, known things are not given, then you have to work it out. And they are constant. Got to be very, very careful here. Constant means not changing. That is also fixed. But it is a reality only for a given time period. These variables are fixed or constant, but only for a certain time period. So within the time period, that particular time period is called relevant range. When time period changes or extended, then these things would change. Of course, prices are not going to be the same for all the time. It changes. I hope it's clear. But once we do the calculation, at the moment, at the time we do the calculation, we assume that all those things are fixed. All those things are fixed. Then, one minute. Sorry. Okay. Over the activity range, being considered, cost and revenue behave in a linear function or fashion or whatever. That is the linear relationship. Non-linear relationships are not entertained. And only factor affecting cost and volume, cost and revenue is the volume. Technology remains unchanged. Again, we do not consider time value of money. You may have learned these things even at advanced level. Here also in the management accounting later on, you will be learning time value of money. But here we simply ignore. Why? We take a short period of time. It does not mean that there is no time value within a short period. There is, but we do not consider, we ignore. There are no changes in stock levels. So stock level would remain unchanged. Like it does not changes in that way, what they say. Simply speaking, we take the decision on the assumption that whatever we produced or whatever we either manufacture or produce as a service or whatever, our operations are going to be converted into cash. That is how we can do the calculation. That means we produce, and it does not mean that we produce and keep something unfinished, like in the case of process costing. Here, basically, we do not deal with, it does not mean that inventory is not there. Inventory is there. But in the calculation, we do not assume that that varies with different values. So simple assumption, yes, produced and sold. Look at this particular graph. It clearly indicates you this linear relationship. If you work out all those things, finally, we must be able to show all this information in this kind of graph. This is pretty much familiar to you in advanced level. Look at the blue line, that is the total revenue. Since the price is constant given the time period, all the time it follows the straight line. Slope is constant. And the red line is the total cost. So whenever these two lines cut each other, intercept, that's called break even. Revenue is equivalent to cost. There is no profit or loss. Then by looking at this graph, you can understand any point in the region above this line. So if I just point it here, if I take the pointer here, this is the break even. Any point in your operation above this line will give you a profit. Why? Your total revenue is greater than the total cost. And any point just below this break-even point will result a loss for you. Why? Your total revenue is less than the cost. Cost is greater than the revenue. So very simple argument. Then we need to know this point and try to be in this region if you want to make profits. Right. Simple differences between absorption costing and marginal costing. Just to recall you, what you have learned as absorption costing is the costing system where you value inventories by using cost assignment that you learn. You absorb cost into product. So therefore, inventory valuation and financial reporting purposes, that is pretty much absorption costing deals with financial accounting. I'm not going to discuss about, aspects of financial accounting here, but mind that absorption costing deals with financial accounting, marginal costing deals with decision making, that is managerial accounting. Cost classification, profit and closing inventory cost per unit and all those things different if you adopt two different methods. We will see how they are different when we take an example. What are these differences? In marginal costing, consider all fixed costs and manufacturing overheads as a periodic cost, right? Fixed manufacturing, all periodic cost, administrative cost, all those things as periodic cost. So it has nothing to do with the inventory as well. Some of the fixed manufacturing costing would be added on, but periodic cost will not be taken. So therefore, inventory valuation will change. But in the case of absorption, marginal costing, I'm sorry, I made a mistake here. In the marginal costing, any fixed cost has nothing to do with the inventory valuation. That is the beauty. Inventory is valued only with variable cost. Again, in marginal cost, so again, you may wonder what is meant. Now we were talking about CVP analysis, right? What is meant by marginal costing? Actually, CVP analysis is done on marginal costing. When we talk about marginal costing, that means CVP analysis, break-even analysis. So therefore, in break-even analysis, for the inventory valuation purposes, we never ever take fixed costs, no matter whether it is manufacturing or other overheads. But whereas in the case of absorption costing, fixed manufacturing manufacturing overhead is added on to the product cost. That is the key difference. Under absorption costing, then when the stock increases, high proportion of the fixed manufacturing overhead is transferred to next year through the inventory. This really deals with inventory valuation. It is very understood for you guys. When inventory level changes, higher the inventory, high amount of manufacturing cost would be shifted to next year, whereas your profit can go up. So, but in the case of absorption costing, it does not happen. Now, we will look at this example. Following actual information is relevant to Alpha Limited for the quarter, 30th September 2020. And your task is to compute the profit for the quarter under absorption costing method and marginal costing method, assuming the number of masks sold was 100,000 and 60,000. Quickly, I know that it would take some time, but even by mental calculation, or maybe by using computer, just doing a rough calculation, do or compute the profit in any method that you like and tell me what method. So, and absorption method, with the marginal method, already you may not have done it yet. That is the CVP analysis. With the understanding of CVP analysis, you can calculate the profit and absorption costing as well. But in case if you did not get the concept very well, forget about it. Work out based on absorption costing because you know it already. Compute the profit. I'll give you 2 minutes. Quickly, everyone.
We can't hear you, sir, if you are explaining.
All right. Okay, I'm so sorry. Technical things really disturb, right? I'm sorry, that's my fault. This is the thing. When we do online lecturing, at least to be effective, there should be a support team. This is not the way of doing online lecturing. This is maybe type of teleconferencing. Anyway, so looking at the answer for this question, you see the difference between cost per unit and absorption method and marginal method. And absorption method, it is 20, marginal costing, it is 12, because marginal costing takes into account only variable cost in determining the cost of unit. Then we'll do the calculation, profit calculation. In both cases, revenue is the same, but the cost of sales and the absorption costing, it is 2 million. So you take the unit cost multiplied by the number of units sold. So therefore, cost of sales and absorption costing, we take cost. But here you take variable cost. It is variable cost is 12 into 1 million, 1 point. Therefore, under absorption costing, your gross profit is 2 million, but your contribution is 2.8 million. There is a difference of 800,000 under two methods. Whatever the difference, we proceed. Non-manufacturing overheads, absorption method also we deduct, marginal method also we deduct. And fixed manufacturing overheads, already this 800 has been absorbed in the cost of production here, but under marginal costing that has not been absorbed there. Therefore, you have to deduct. So finally, net profit for the period under both methods become 1.3 million. So there is no difference. Why? That is the question you should ask. We have adopted two methods, CVP method, that the marginal costing and the absorption costing, but we did not see any difference in the profit. Why? Why don't you see any difference in the profit? Anyone can give me an answer. Chat box. How can I get it? I hope that you are hearing me, right? So someone has just posted saying that not hearing, maybe the previous post. I hope that you are hearing me now. Do you hear me?
Yes,
Can
sir,
someone speak up? All right. Then, well, what is the difference? Can someone tell me the reason why there is no difference? Under two methods. Yeah. Can someone post an answer or just tell me the answer? You can simply tell me what is the answer? What is the reason why there is no difference in the profit under two different methods? Anybody? So that is the learning, not the calculations. All these big calculations won't give you anything. But if you know the reason why there is no difference in the profit, that is really a learning. Yes, you are right. Under both methods, all the costs have been considered. That is true. But there is, like, even I'll show you when it goes to the second situation, even all the costs have been taken into account, there would be a difference in the profits. But here, the reason why there is no difference is something else. Yes, so I got the answer. There is no closing stock. So that is the answer. Since there is no closing stock, no matter what method is absorbed, finally everything is just deducted in arriving to profit. Now you can see the difference. This is for 60,000 scenario. You manufacture 100,000 but sell only 60,000. Sales value, cost of sales, gross profit, contribution. So calculations straightforward. And non-manufacturing overheads are deducted in both cases. Manufacturing overheads, full amount is deducted under marginal costing. Inventory is valued at um, variable cost. Variable cost is 12. 12 into 40,000 unsold stocks is 480,000. So therefore the closing stocks and the marginal costing is relatively lower than that of absorption costing. Absorption costing is the closing stock is higher. In other words, some costs which are recognized under marginal costing for profit calculation for a given period are deferred to the next period under absorption costing. So that is the difference. Got it? Um, so the difference in the profit should be exactly the difference in the stocks valuation. Here 500,000 is the profit here, 180,000 is the difference is 320. It should be the difference in these two values if you have not done any mistakes. So obviously that is the difference. Now we will look at, I mean, even though they are explained in equations and all those things, the same thing is interpreted or reproduced in different equations. Here, a simple equation is this. Simple equation goes like revenue minus variable cost when it comes to contribution minus fixed cost will give you the profit. So that is the simple equation. It is explained like this. Profit, final profit in CVP analysis is total revenue minus total cost. That is true in all the cases. Profit can be explained then total revenue minus variable and fixed cost. And profit is explained the total revenue minus total variable cost contribution minus fixed cost. So here, when you deduct TR minus TVC gives you contribution. Contribution minus fixed cost. Revenue minus total cost. Revenue minus fixed cost and variable cost. Then the total contribution minus total fixed cost. So finally, that's what I just told you. It is the same thing. So you should not learn these as four equations. It's only one equation. If your total contribution is greater than fixed cost, there is a profit, of course. Total contribution is equivalent to fixed cost, that means break even. So therefore, in attempt of being break even, your target should be to realize or cover or get a contribution equivalent to fixed cost. Any contribution less than fixed cost, you end up with a loss. Then in these three scenarios, unless you have any other specific reasons to run this operation, the operations related to this third scenario, total contribution less than fixed cost, is not advisable to run it for a longer period of time. But for a short period of time would be all right. But in a case, if your contribution is, say, like if there is a contribution, of course, that could be used for managerial decision making purposes, but the contribution is negative, the contribution is negative, then such kind of businesses should not be thought of, because you sell, like you incur something and sell at a price that is lower than your variable cost. You buy some product at 100 rupees and sell it at 90, you shouldn't do that. Okay, example. Selling price per unit 200, direct material 20, direct labor 30, variable overhead per unit. Calculate the contribution per unit quickly in a fraction of a second. Contribution per unit? Yes, of course. What exactly? I can't see this chat box. Okay. Yes. How did you get it? Yes, 200 minus all the variable cost. Direct material 20, direct labor 30, 50, variable overhead 20, 70, they have 100. Now, I hope that you understand, you should have understood. Is there any complication in this calculation? No. Therefore, in management accounting, even financial accounting or any other management, actually nowadays, challenges are not with the calculations. Challenges are with understandings. Challenges are with interpretations. Challenges are with decision making. But unfortunately, due to some other reasons, to great extent, our examination papers, our learnings involved with unnecessary calculations. Therefore, another important concept called contribution margin ratio, use of ratios. You can calculate it in two ways. One is take the total contribution, divide by the total sales and multiply it by 100. So if you know the contribution, so express this as a percentage of sales, that is called contribution margin or CS ratio. So look at this acronym. So these are the words you CS. C means contribution, contribution divided by sales. Sometimes we call PV ratio as well. CS ratio and PV ratio. I'll come to PV later. CS ratio, contribution divided by sales, straightforward. And if you want, you can calculate it this way. Unit contribution divided by selling price, unit selling price. Unit contribution divided by unit selling price is also like this. PV ratio. Why is it called PV ratio? Remember, when we talk about CVP analysis, cost, I told you there are two forms, volume in two forms, profit is also two forms. Therefore, contribution, here C does not refer to cost. C refers to contribution. Contribution is the one form of profit. If you use the ratio from a broader meaning, we can say profit. But to represent the profit, we use contribution. Volume, remember, CVP. From CVP standpoint, P means profit, where we substitute it with this contribution, and volume means it could be either sales or units. Here we have taken sales. That is the meaning why we use both. You got it? Right. Now, do this exercise quickly. Compute the total contribution and contribution margin ratio. It's very easy. Should not take more than 2 minutes. this information is for 1 month. Month of September. Yes. Quick calculations. Total contribution, margin ratio, and the profit for the month. I don't see any answers. Okay. Okay, good. 75% margin. Then, of course, if you have taken that answer, definitely total contribution also should have been calculated. Okay, we'll have a look. So this is the answer. Contribution per unit 75, half 100. Yes, we have a look. Yes, total contribution. In one answer it is 200,000. In other one 7.5 million. 75 million. Yes, I have also just anyway. We'll have a look. 75%. Sorry, 75 rupees. 100 minus variable cost 20. Yes, there is. Yes, 75 million. 75 million. Good. So when we express this 75, oh sorry, here there's a mistake when I copy it. CS ratio is not 25, it should be 75. I will correct it here. Otherwise, yeah, you're right. It should be 75%. It should be 75%. Now, total contribution 75 million. What is the profit then? Total fixed cost is 15 million. Again, very simple mathematics. Now, break-even point. I just already explained you. Break-even point is nothing but the point at which there is no loss, no profit. Recall that particular graph. Anything above the break-even point is the profit region. Anything below the break-even point is the loss region. It can be calculated in many ways. There is no hard and fast rule. Even in the examination, if you find any other way, you can calculate. Actually, these are few methods given to you. You better think of any other ways. So simple way of calculating break-even point in units is taking the fixed cost divided by the contribution margin, contribution per unit. And break-even point in value can be taken by dividing fixed cost by CS ratio. Actually, here, if you want, use this, here's a fixed cost. Both the equation, the numerator is the same, fixed cost. Here contribution per unit, and here CS ratio. In the CS ratio, actually in this example, that is 75. Divided by 100. Okay. This is the CS. So when you divide 75 by 100, it gives you CS ratio. 75 means contribution. Here, you have taken 75. Here you have taken 100. In other words, actually, you have multiplied this answer by 100. Then only you get the break-even value. So when we have a division, you divide fixed cost by this, you can express this, if you want like this, fixed cost divide by CS ratio, you can change the terms upside down as a multiplication. Therefore, 100 and divided by 75. That is the meaning. So what has happened? If you forget about this 100 for the time being and compare it with the previous one, fixed cost divided by the contribution. So fixed cost divided by the contribution. So therefore, how to get the value? The break-even point in unit should be multiplied by 100 sales price. So once it is put into a concept, instead of showing these calculations, we can straight away say that yes, the cost, fixed cost divided by CS ratio. So that is the basic understanding. Okay, with that. Okay. Activity using the same information providing the big 6.1. Find out both in units and sales value. Yes, quickly. What is the break-even point? Yes, I hope that you did it. Okay, 200,000 units. And yes, value is 2 million. Thank you. Perfect. 200,000 and value is 20 million. 6.3. Explain what does Tasty Foods do to achieve this task. So carefully read. This is a question which deviates from basic calculations and asks you to think of something else. Tasty Foods is a Sri Lankan restaurant which serves mid-price food to customers, average price. Maybe, I don't know which kind of restaurant, average. Maybe Gyans or somewhere there. It's strategy to provide quality food. Quality is number one at reasonable price. But I do not know the meaning of reasonable, right? What is meant by reasonable price? Do you have any idea? Actually, there is no meaning. It depends, right? Okay, just kidding. Hence, its variable costs are high due to the usage of high quality ingredients. It says that you give a quality food at a reasonable price, maybe low price, so whereby your variable cost is very high. Selling price is also fixed to cater to mass market. As such, its contribution margin is not that high, it's not that significant, very tiny margin, right? In case if something goes wrong, you would end up with losses. That's the thing you have to understand. To cover it, so for example, if there are lots of wastages, it would be, in order to cover up its fixed cost and make a profit, it has to compensate with high volume. Explain how do you achieve high volume and to face this particular situation. Think for a while. Yeah, task is to just not any calculation. Tell, so what should this tasty food do to have, say, more profits? Of course, one task is to increase the volume. In what ways can tasty foods increase the volume, or in what ways tasty food can increase the profit if this is the situation? Okay, simply think what are the ways in which tasty foods can increase the profit? Just like in addition to increasing the volume. But introducing new product is a different, okay, good. So just see when we, now you can understand the importance of the discussion. If you can ask question directly, that would be much better looking at the slide. So someone said that maybe introducing new products. So introducing new products, of course, that is a good idea, but that cannot be handled when we talk about a single product scenario in CVP. Then it should be a different scenario. Then in a multiple product situation, later we will discuss it next week, we will discuss CVP analysis with multi-product environment. Yes, that would be good answer, if that is the case, but not an answer to this. Then minimizing its fixed cost. How will you minimize your fixed cost? Just as a saying, we can say it, but in what way? It is extremely difficult. But there may be some wastages, so you can think of some processes, internal organization. So if you can do it, yes, that's good. If there are some wastages, unnecessary fixed costs, of course you can think of. By reducing the variable cost per unit. How do you reduce the variable cost? In this case, it is highly risky and challenging. Why? Whenever you try to reduce your variable cost, you can't maintain the quality. If the quality goes down, this month you may increase your profit, but next month no customers will come because they realize, but your quality has gone down. So therefore it is extremely difficult to reduce the variable cost. And therefore it is not that even you can't increase the price. Whenever you try to do this thing, customers will. So therefore, it is practically a challenging question. It's not that easy. So the best ways are to analyze carefully the internal operations within the organization. In this analysis might help you, as someone suggested sometimes, to reduce some fixed costs, not all, but sometimes these processes might help you to bring maybe new innovation. Even variable cost can be brought down by efficient cutting system. Yes, someone just mentioned about the product modification. Yeah, modification also with respect to this food, it is not that easy. Maybe if there are any unnecessary cost, maybe packing, coverage, or any other costs which do not involve with the food, quantity and quality of food would be all right. But if you do something to reduce the quantity, reduce the quality, it is disastrous. Technically that is correct, but practically it would not be sustainable. So, okay, thank you very much. So now you understand. That's why I want you to discuss, talk, that is a learning rather than just keying the numbers and getting an answer, okay, 25,000, 50,000. Now, profit planning situation, you may have already heard about this thing. Therefore, CVP analysis can be used to determine, okay, I want to achieve this much profit, that much profit during this year, next month, within a given time period, because this is your planning. So plans may not work as you planned. Accordingly, there may be deviation, whatever it is. Always organizations need to plan, because if you have continue with the plan, deviation can be seen. Corrective actions, what we call remedial actions, can be taken. Then what is the use of BEP or CVP analysis when organizations think of profit planning? How are we going to solve these issues? We'll see. Then in order to reach a target profit, actually your contribution margin is the key. Remember, the CVP analysis, the key driver is the contribution margin. Therefore, you can divide the fixed cost that you have to recover and target profit. This is the task that you have ahead of you. Divided by the contribution per unit will tell you, okay, how many units should be manufactured in order to or sold in order to have this profit. If you want to calculate the target sales value, then the same value can be divided by CS ratio. We'll take this example. Calculate the required sales to earn a target profit of how much? 80,000 in few seconds. Quick calculations. Okay, 10,000 units. Good. What would be the approach? You need to cover, okay. Yeah, 10,000. Good. What would be the approach? You need to cover 120 plus 80, 200,000. Since the value is not the unit, you need to take CS ratio. What is the CS ratio? Selling price minus variable cost is 20. 20 divided by 80 means 25%. So therefore, 200 divided by 10,000 is the units. Yes, 200 divided by 25%, it gives you 800,000. Because the calculation is not the units. Calculate the required sales. Required sales. Yes. Yes, you are right. So one just wrote 200,000 divided by 0.25. Exactly correct. So that is the answer. Fixed cost target profit. This is your target, then final target divided by 25%. It gives you. So this is the way you should work out, even in case if you want to do calculations. Don't think of the formats. Don't think of formulas. Don't think of the ways in which you were told in the class, and don't memorize, don't recall numbers. Use the logic and do the calculation rationally. In a matter of seconds, you can get the answer. Activity 6.4. We will do this activity and I think stop for today. Quickly, how many masks should be sold during the quarter ending 31st March this month to reach the business to its break-even point? So you are given direct material cost, labor cost, other costs, that is 16 plus 420, selling price, then you know already the margin, contribution margin, fixed manufacturing cost for the quarter is given, fixed non-manufacturing costs are also given, 6 million altogether, 4 million, 6 million. So that's your target. That's your target. And the mask material cost, this thing, and company has a currently monthly production capacity. Monthly, right? Remember, 250,000, that is monthly. It is expected that the company will operate at its full capacity. Now you need to work out how many masks should be sold during the quarter. So these costs are for the quarter. Then you can quickly take the contribution margin and tell me the answer. Somewhere already. Yeah, 600. Yeah, yes. Why there is a loss? What is the loss? 6 million divided by 20. Someone has given an answer. Do you see your chats as well now? When I'm not sure whether. I think someone has. Yeah, 6 million is the cost to be recovered. Divided by 20 will give you 300,000 units. That is the number of how many masks to be sold during the quarter to reach the break even, 300,000. 300,000. So that is this. That is the expected profit or loss for the quarter. So if you manufacture 300,000, that is break even. But during the quarter, so how many are you going to manufacture? 750, not 50,000, because this 250,000 is only for 1 quarter. Sorry, 1 month. 1 month. Therefore, it should be multiplied by 3. Okay, I have not just marked the answer there. Is that clear? Break-even point is 300,000. Profit, therefore, you can calculate it in different ways. Yeah, profit is 450 into 20. Your total number of units during the quarter is 750. From the 750,000 minus 300, that is break even. The excess over and above the break even, later we will be discussing, that is the margin of safety. You are in a safe position. If you can manufacture 750 units, right? 750 units within the quarter, you are in a safe situation because your need is just 300,000 units. Whereas you have manufactured 750. Therefore, additional 450,000 units. 450,000 is your safe zone. Each unit gives you a contribution of 20. Therefore, anything above, any production above the break even adds to your profit. Therefore, 450,000 into 20, 9 million is your expected profit. Exactly. Good, that you understood the concept. 9 million is your profit. Actually, this 9 million is your margin of safety. In other words, isn't it? So what does this profit tell you? What does this profit imply? As long as you have a profit, you can run the business without having a problem. That means you can take decisions up to an amount of 9 million in that way or this way, either to expand it, to broaden it, to make some experiments without having any fear. Why? You have a profit of 9 million. Because so you have earned it above the break even. When you surpass your break even point, you are in a safe zone. Therefore, that safe zone, with this example, margin of safety is the excess of budgeted sales over the break. Not only the sales, it would be sales, profit. In terms of like profit, it is 9 million. In terms of sales, how much? 40 into 400. You can express, you can express in any of these 3 forms as sales, margin of sales safety. If it is with respect to this question, 40 into 450,000. Quickly work it out. If you want, you can say margin of safety is 450,000 units. If you want, you can say margin of safety is 9 million. If you tell it in either of forms, that's all right. Or even if you want, you can say margin of safety is, you can express the margin of safety as a percentage of total revenue. Your margin of safety is 450 into 40. Total revenue is 40 into 750. So therefore, 450 divided by 750 as a percentage, you can express this. Different ways of expressing. So this example also tells you selling price. This variable cost is 60, therefore contribution margin is 20. Safe. Total fixed cost is 20. Expected sales units 15,000. Calculate the margin of safety units as a percentage of capacity. So what is the break even? So 20, 120 divided by 20, that is 60,000, right? 20 divided by 6,000, right? 20, therefore 12,000, 6,000. So break even point is 6,000. Yeah, correct, 6,000. So expected sales is 15,000. So then what is the margin of safety? 6,000 divided by 15. So therefore 40%. Right? You need not to have any complicated calculation for this thing. But this relational understanding holds a key of learning. Right. I think with that, we will stop for today. But I could not discuss activity 6.5, 6.6. Yeah, actually 6.5 and 6.6. So no worries. We will discuss these things next week. Only very few. In fact, I could have finished it because of the previous week coverage. I could not. Okay. You ask how to get margin of safety. Margin means always a percentage. Right? You can calculate in any way. So by looking at this, how can you get it? Your expected sales 15,000. Your break even, okay, good. I don't know whether you asked the question because I made a mistake. Huh? What is the mistake? I just told you that margin of safety is 6,000 divided by 15,000, isn't it? It's wrong, right? So if you have asked that question, because of that, so you are really smart. Good. So you have understood. Actually, margin of safety is anything above the break even. Break even number of units is 6,000. Difference between 15,000 and 6,000 is 9,000. Therefore, your safety, your margin of safety is 9,000 in units. In value, 9,000 into 80. As a percentage, 9,000 divided by 15,000. So therefore, 9,000 as a percentage, 9 divided by 15 means 60%, not 40, 60%. Yes, exactly. Someone has calculated 9,000 divided by 15. Perfect. That means you have understood it very carefully. Again, I summarize the starting point of finding the margin of safety is to determine the break-even point. Break-even point here is 6,000. So therefore, margin of safety is the difference between your level, current level, and break-even level. That is 9,000. Then if you want, you can say your margin of safety is 9,000 units. If you want, you can say your margin of safety is 9,000 into 80, this much value. If you want, you can say that margin of safety as a percentage, 9,000 divided by 15,000. If you want, you can say that your margin of safety in terms of profit, how much? 9,000 into 20, 18,000. That is profit. In 4 ways you can express your what do you call margin of safety. Just give me 1 minute. I think I would be able to finish. So there is another lecture at 6. I need to check it whether it is at 6 or 6:30. Wait a minute. In that case, because only one question is left. If you can finish it, that's great. Okay, 6:30. Then we can finish it. No problem. 6.5. Using the information given in 6. Calculate the margin of safety in units. Okay, already we did it, right? So that means we can finish the lecture. In units, 9,000. As a percentage,
So can you share the
60%.
screen?
If the quarterly sales volume is expected to drop by 20%, what would be the effect on this firm's profit? If quarterly sales volume drop by 20%, so 20% drop means 1,000, 3,000, 12,000. Then what would happen? If it is 12,000.
So can you share the screen?
Sorry. Yeah. Margin of safety, we is 6.5. 6.6 is yeah, this one 6.5. Using the same information given 6.4, calculate the margin of safety in units and as a percentage. Already we did it. If the quarterly sales volume is expected to drop by 20%, what would happen? As of now, it is 15,000. 20% drop means 12,000. Then your margin of safety becomes 6,000. Margin of safety become as a percentage 50%. But your profit also goes down. 20 into 6,000, that is 12,000. So likewise, you can do a whole range of calculation. Yeah, 20 into 3,000. Yeah, impact is here. Profit would decrease by 6,000. Exactly correct. I hope you all understood the concept. Based on that, you can ask additional questions and improve your knowledge. Then setting sales targets with income tax. Sometimes, actually, we in real organizational situations, when we take decisions, we need to consider tax as well. Then, whenever we want to have a target profit after tax, target profit means it could be profit before tax or after tax. What really matters for the owners, what they are interested in, not the profit before tax, but profit after tax. What can they take home? Therefore, target profit, because whenever you earn a profit, income department comes and takes. So therefore, that profit has to be inflated by dividing your given profit by 1 minus T. So it will give you the profit before what you really want to have, target profit after tax. So for example, if you want to have profit after tax of 20, what would be the break-even point? They automatically you adjust. If you look at this this part, target profit divided by 1 minus T, this calculation gives you nothing but profit before tax, in other words. So you should not be really deceived by unnecessary formulas and numbers. Instead of saying profit after tax divided by 1 minus T, this is profit before tax. If profit before tax is given, that's fine. That's it. Not big things. Then quickly work out. Suppose that the management of Swedish is want to find numbers of tablets of soaps should be produced and sold to generate after-tax operating profit of this month after tax. So this element pays a corporate tax of 25%. So therefore, divided by 4.5 million by 25%, it will give you how much? 1 minus 7, so 75. So 4.5 divided by 7.5 will give you the answer. How much is it? Can someone work it out? So if you want, I have to go to the Excel. 4 million. Yeah. What is the answer? 4.5 divided by 7.5. Therefore, 6 million. So Swadesi needs a profit before 6 million plus this fixed cost. What is the fixed cost? Expected fixed cost. No, this is not Swadesi. So information is not there pertaining to fixed cost. Therefore, you need to recover 6 million. Therefore, with that, profit before tax is 6 million. What is 18 million? Someone has mentioned 18 million. No, profit before tax is 6 million. Not 18 million. I do not know whether you refer to something else, 18 million. Because here in the Swadesi Limited, we do not know the fixed cost. 6.1 is fixed cost there. 6.1. So if this is the one, yes, Swadesi. Yes. Fixed cost is 15 million, right? So therefore, fixed cost plus this 6 million, you need to recover 21 million. 21 million. 21 million. So 21 million divided by the selling the contribution margin, that is 75, will tell you the number of units. Yeah, profit before tax is 6 million. Total fixed cost is 15 million. Therefore, 21 million divided by the contribution margin, that is 75, will tell you the number of units. And multiply it by 100 will give the total sales. So actually, in one question, you can work out all those things. If you have any question, please ask. Otherwise, we can wind up. So until you ask some questions, so I will just brief you these things in English and Sinhala. So break CVP analysis is straight away. So this is part one, very simple management technique or management tool, which deals with three variables: cost, volume, and profit. Cost takes into account either direct, so fixed or variable. Volume refers to either units or sales value. Profit refers to either contribution or the total profit. So therefore, eventually, we deal with 6 variables. These decisions are discussed within a short period of time called relevant range. Therefore, they are rather short-term decision making. The relationship between cost, volume, and profits are expressed in linear relationships. In order to establish linear relationships, we make assumptions. What are they? Those assumptions, we assume within the time period, all those variables are known and given values are constant. But later on, we will release this assumption and do some calculations such as sensitivity analysis, something like this. For the time being, we assume things are known and constant within a short period of time, then we work out. In these calculations, what matters for us for the decision making is to know the level at which our organization, our unit, project, or whatever can run without having any problem. That means without failing, without collapsing. That particular point, critical or the pivot point, is called break-even point. Break-even point refers to a place or the situation with the point where there is no profit, no loss. Therefore, any level of operation above the break-even point gives profits to the organization. Any point just below the break-even point, of course, incurs losses to the organization. Therefore, we have to avoid. We need to be always, it is good for an organization to be either on the break-even or above the break-even. If you are at the break-even, you are not in a safe zone. It is a bit risky. Therefore, better to be in a profit zone. As long as you are in the profit zone, you are in a safe zone. Therefore, that particular margin additional advantage gap that you have is called margin of safety. This margin of safety can be calculated in terms of number of units, in terms of total sales value, as a percentage, or in terms of profit or whatever. So finally, these relationships, so anything can be calculated by looking at and doing the analysis through normal linear relationships. Next week, we will discuss about the multi-product environment and a little bit complicated issues. Okay, මම හිතන්නේ මේක ඇත්තට අමාරුම පාඩමක් නෙමෙයි. ඔයගොල්ලන් ඇඩ්වාන්ස් ලෙවල් වලට කරලා තියෙන නිසා. නමුත් අපි මේ ඩිග්‍රියේදී උත්සාහ කරනවා ඇඩ්වාන්ස් ලෙවල් එකේදී කරපු අර ගණනය කිරීමට වඩා චුට්ටක් එහාට ගිහිල්ලා මේක ඩිසිෂන් මේකින් පැත්තට කොහොමද යොදාගන්නේ කියන තත්ත්වයන් සලකා බලන්න. එතකොට මේ CVP කියන අකුරු තුنين අපිට කියන්නේ cost එක, volume සහ profit කියන. හැබැයි එතෙන්දී විශේෂ තේරුම් සහිතව තමයි cost, volume, profit පාවිච්චි කරන්නේ. cost කිව්වහම එක්ක variable cost නැත්නම් fixed cost. වෙන cost අපි අදාළ නැහැ. profit කිව්වහම ඒක අපි express කරනවා එක්ක contribution එක විදියට එහෙම නැත්නම් total profit එක විදියට. volume එක කියලා කිව්වහම අපිට අදාළ වෙන එක units එහෙම නැත්නම් value. ඉතින් ඔන්න ඔය තියෙන variables අතර relationship එක තමයි අපි මේ CVP analysis එකෙන් පෙන්නන්නේ. ඒ relationships ප්‍රායෝගික ලෝකයේදී විවිධ විදිහට තියෙන්න පුළුවන්. නමුත් අපි මේ ගානේදී ගන්න අපි මේ concept එක තේරුම් ගන්න නම් අපි හිතනවා අපි උපකල්පනය කරනවා මේවා අතර linear relationship එකක් තියෙන්නේ කියලා. එහෙම linear relationship එකක් තියෙනකොට අපි ගණන් හදාගෙන ගියාම අපිට හොයාගන්න පුළුවන් වෙනවා එක point එකක් අපි යම්කිසි operation එකක් කරගෙන යනවා නම් ඒ operation එකේ ලාභද පාඩුද එහෙමත් නැත්නම් ඒ වගේ තැනකදී ඉන්නේ කියලා බලන්න. එන්නේ එකට decision එක ගන්න CVP analysis එකේදී අපි හොයාගන්න තරම් point එකක් ඒකට කියනවා අපි සමච්ඡේද ලක්ෂ්‍ය break even point. break even point එක අපිට උදව් කරනවා break even point එකට උඩින් තියෙන ඕනෑම ලක්ෂයක තියෙන නිෂ්පාදනය අපිට profitable. හොඳ පැත්ත. break even point එකට යටින් ඉන්නවා නම් අපිට පාඩු. ඒ නිසා අපි පාඩු පැත්ත එච්චර හිතන්නේ නැහැ. පාඩු පැත්තෙන් අයින් වෙන්නට ඕනේ. පාඩු පැත්තේ ඉන්නවනම් අඩු ගන්න break even point එකට එන්නට ඕනේ. break even point එකෙන් උඩට යන්නට ඕනේ. so break even point එකෙන් උඩින් ඉන්න හැම අවස්ථාවකම අපි කියනවා safe. ඉතින් profit නේ. අපි margin of safety කියන්නේ ඒක. ඒ කියන්නේ අපිට margin එකක් තියෙනවා. ඔය ටිකක් ගන්න නටන්න ශ්‍රී ලංකාවේ දැන් අපි කිසියම් වැඩ කටයුත්තක් කරලා ලාභයක් ගත්තොත් ටිකක් pool එකේ ඉන්න පුළුවන්. ඒ ලාභේ වියදම් කරලා පොඩි ෆන් එකක් ගන්න පුළුවන්. ගමන බිමනක් යන්න පුළුවන්. කන්න පුළුවන්. වෙන වැඩක් කරන්න පුළුවන්. ඒ වගේම තමයි මෙතන. විතර දඟලන්න ඕනේ අපිට යම්කිසි අතිරික්තයක් නිෂ්පාදනය වෙලා තියෙන එකට අපි කියනවා ව්‍යාපාරික margin of safety. ඉන්නේ margin of safety අපිට ඉදිරිපත් කරන්න පුළුවන් units විදියට, sales value එක විදියට, profit එක විදියට, එහෙමත් නැත්නම් percentage එකක් විදියට ඕනම percentages volume එක විදියට, sales විදියට කැමති විදියකට අපිට ඉදිරිපත් කරන්නට පුළුවන්. ඔකට ඔය තත්ත්වය තමයි අද අපි සාකච්ඡා කළේ. break even analysis එකේ CVP analysis එකේ ටිකක් ප්‍රායෝගිකව එන තත්ත්වයක් තමයි මේ products කීපයක් හදනවා. multi product විශේෂයෙන් management වල තියෙනවා product mixing කියලා. product mix එකක් භාවිත කරනකොට කොහොමද මේ decisions ගන්න. සමහර products complementary. එතකොට අනිත් එක පාඩුණත් කරන්න සිද්ධ වෙනවා. එවැනි තත්වයකදී අපි කොහොමද decisions ගන්න කියන එක තමයි මේ multi product environment එක සාකච්ඡා කරන්නේ. right. එතකොට අදට එච්චරයි. මොනවා හරි ප්‍රශ්න තියෙනවා නම් අහන්න පුළුවන්. මොකද ප්‍රශ්න දාලා නැහැ. Are there any questions? If there are no questions, we can wind up today's session. Thank you very much. See you next week. So you are requested to read the chapter and the presentation slides uploaded in the LMS before coming to the lecture. Actually, it's always not requested, like you better attempt on all the questions, activities before attempting the lecture, then that would be much easier. We can finish the lecture within a short period of time with a very good understanding. Thank you so much. Have a nice weekend. Bye-bye.